All right, Brian, we just launched Yahoo Finance's third volume here of the Yahoo Finance Chartbook. And I bring that up because you kindly enough sent over a chart, which we included here among the 30 plus charts here that really signal some of the trends and most important things that investors should be keeping in mind. And I bring that up because of that upside that you were just talking about, or opportunities still within the market. The chart that you sent over, we have it up on your screen here, the S&P 500 max drawdown and what's happened here during the second year of the bull market. What's your read on what we're seeing and ultimately what this signals here just in terms of that direction going forward?
Just kudos to Yahoo, because I sent you a bunch of charts and you nailed it. I mean, this is the chart in particular that people should be looking at. Now, there's been a lot of strategists talking about a 10% correction. Many of these strategists have not been bullish all along, and now they've kind of entered the bullish fray and now said the market needs to roll over. I'll remind you what our call has been. We said in November of this year that 2024 was the second year of the new cyclical bull market, which began in October of 2022. We were in print on that as well. And the average drawdown since 1949 is 9.4%. Why that is concerning is we've only had a 5.5% correction so far. And the market, all along the time, this market has become quite frothy, with everybody kind of looking to the big cap tech stocks and chasing the market, whether that's fear of missing out or just momentum, or just by and large wanting to perform, because many portfolio managers on the institutional side have been underperforming. They've been chasing the market. Now you look at a lot of the strategists that, like I said, that I like to call them the Johnny-come-latelys, that have started to chase the market and up their market targets. The market's ripe for a pullback from a sentiment perspective. And now we've seen in terms of rotation, we still think we're going to get that 9.4% correction, but that's a buying opportunity. Why is it a buying opportunity? Because the average revival, let's say, from that 9.4% correction, average drawdown since 1949 has been 15.5%. So I'm throwing a lot of numbers out there, but what does it mean? It means that stocks are going to be higher at year end. Stocks will be higher at year end in our view, all part of our 25-year secular bull market call, which we've had in place as strategists since 2010.
Brian, I want to end with your outlook for the earnings cycle and how that plays into the macro picture. What are you going to be looking at this cycle to suss out whether or not we're seeing some softness in some earnings prints that indicates a Goldilocks scenario, or some softness that indicates a scarier slowdown?
Well, remember the formula for investing, Maddie, in our view, is stocks lead earnings, which lead the economy. Stocks lead earnings, which lead the economy. Stock market's been up a lot. It's going to tell you, it's already telling you that earnings are going to be strong, and the economy is going to continue to be strong with respect to, or stable at least, with respect to the Goldilocks. Remember the last time we had Goldilocks was 2019. I remember the Fed was raising rates in the face of tariffs in 2018, and then the Fed pivoted in 2019, and that really ushered in true Goldilocks. People have been talking about Goldilocks here for a while. I think from the guidance perspective, I think a lot of people have forgotten that tech typically is softer traditionally and historically in the third quarter. People forgot about that because they just think all that tech stocks do is go up. We've obviously forgotten about 2022. So I think from a tech perspective, you're going to start to see a little bit more caution, and that's okay, especially given the fact how strong they've been. You might see a little bit of rotation, but that does not speak to where we're going to see further earnings strength in the market, especially within financials, parts of healthcare, parts of industrials. And if we see a stabilization of earnings, of interest rates, like we do believe we're going to see, a more stable GDP growth in terms of this 2 to 3% range, we think that bodes very well for a Goldilocks type scenario in 2025 and 2026.